Hello friends, welcome to Commerce Guide. This is Pranali. Today's video is all about the modern approach of accounting. Now the accounts have been classified into two groups. First is traditional approach, second is modern approach. Now our traditional approach is also known as the British approach and a modern approach is known as the American approach. Now traditional approach contains three types of accounts: personal account, real account and nominal account. And modern approach contains six types of accounts: assets account, drawings account, expense account, liabilities, income, and capital account. Now, these traditional rules are also known as the golden rules of accounting. I have made a separate video on the golden rules of accounting. Okay, to watch that, link is being given in the description box below. Fine, now quickly let me tell you the rules of the traditional approach. Now, a personal account rule says that debit the receiver, credit the giver. Real account rule says that debit what comes into the business, credit what goes out of the business. Nominal account rule says that debit all the expenses and losses, credit all the incomes and gains. Okay. Now, in today's video, we will see in detail the rules of modern approach. Okay. Now, under the modern approach, we follow the accounting equation. Thus, it is also known as the accounting equation approach. Okay. Now, we'll see that what is the equation here. So, the equation here is assets is equals to liabilities plus capital. Now, capital is also known as the owner's equity. Furthermore, it can be expanded as assets is equals to liabilities plus capital plus revenues or incomes minus expenses. So this is the accounting equation. Now this accounting equation should remain balanced every time. That is, assets should be equal to liabilities plus capital plus revenues minus expenses, because we know that each transaction has a dual aspect. Thus each transaction will either affect the debit side and the credit side. So we follow this accounting equation in the modern approach. Now we have six classifications here. Okay, now first let's understand what does each of this type mean, and then the logic behind that, and then we'll find the rules of it. Fine. So first let's see, what do you mean by assets? Now assets are the properties or possessions of the business which has a future economic benefit. Okay, assets are the properties which has the future economic benefit. For example, land, building, machinery, vehicles. Okay, now why are these an asset to the company? Because the company has control over it. Okay, because the company has control over it and it has a future economic benefit. Okay, these items are known as the assets to the company because the company has control over it, because it possesses this all these things. Okay, so it has control over it and it has a future economic benefit. Now, for example, let's say machinery. Okay, now machinery will be with the company for, let's say, 5 years, 10 years and all. So for that many years, this machinery produces the goods. Okay, so will generate sales, will generate revenues from that machinery. So it will give us the benefit for the future. Okay, for future 5-10 years it will give us the benefit. So this machinery is known as what? The asset to the company. Okay, so in the same way, building, vehicles, land, this everything will stay with the company for a longer period of time. And for that many years, what will happen? It will generate revenue to the company, and that benefit it receives. So it is known as what? Assets to the company. Fine. So these are the assets. Now let's see what are the liabilities. Now liabilities are the amounts that an entity owes to the outsiders. These are the financial obligations or debts payable by the business. Fine. In simple terms, liability is nothing but what? The money which you owe to someone. Okay, the money which you owe to someone. Now, for example, let's say Is a person, okay, suppose he takes loan from a bank, okay, he takes loan from a bank. Now he is under the financial obligation, okay, because he has taken loan from the bank. But now what he has to do is that in future he has to pay this money back. Yes, because now in past he has taken the loan, in future he has to pay this money back. So he is under the financial obligation, so it's a liability here. Okay, now let's say another example. If you have purchased goods from someone, okay, suppose this is a person, you have purchased goods from him, okay, and did not pay the money to him. Okay, you did not pay the money, you did not pay the money to him. So this person or the supplier is known as the creditor. Okay, this person is known as who? He is known as the creditor because we have purchased goods from him but not paid the money yet. Okay, so this is word creditor. So these were the bank loan, debentures, creditors are all what? They are the liabilities. Fine. Now let's see what is capital. So capital is the money brought into the business by the owner is called as capital or owner's equity. Now suppose there is a person, okay, he wants to start a business. Okay, let's say any business if he wants to start. Now to start that business, he is in requirement of rupees, say 10 crore. Okay, so what he will do is that he will invest rupees 10 crore in the business. Now this money which he has invested into the business is known as word capital. Okay, this is known as word capital. Now this capital can be brought in cash or in the form of assets. Okay, this person who is the owner of the business, he can bring in cash or he can bring in what? Assets. Okay, that is known as what? The capital. Okay, and it is shown on the liability side of the balance sheet. Okay, now let's see what are the drawings. Now the amount of cash or goods which is withdrawn by the proprietor or by the owner from the business for his personal use. Okay, this is most important here. Okay, so drawings are what? The amount of cash or goods which is withdrawn by the proprietor from the business for his personal use is known as what? Drawings. Okay, now see capital was what? Okay, if the owner invests the money in the business, it is known as capital. Now this owner, if he withdraws the money from the business for his personal use. If he withdraws the money from the business for his personal use, then that money is known as what? Drawings. Okay, so capital was what? The money invested into the business, and drawings are what? The money withdrawn from the business for his personal use. Then they are known as what? Drawings. Okay, as simple as that. Fine. Now let's see what are the expenses. Now expenses are what? All the costs incurred or money spent by a business in order to earn the revenues is called as what? The expenses. Okay, so see, if it's the cost or expense that you incur to run the business smoothly. Okay, to run the business smoothly, the cost which you incur, they are known as what? The expenses. For example, rent paid. Okay, we are paying the rent of the company. Salary paid, we are paying the salary to the employees. Electricity charges, interest paid. So these all things are what? The expense to the company. Okay, now one thing to remember here is that in expenses do not have the future economic benefit. Okay, expenses do not have the future economic benefit. For example, see, now rent paid. Okay, now see, suppose we have used a space of land for a month. Okay, for a month we have used the space of the land. So for using the space of the land at the end of the month, what we are doing, we are paying the rent. Means what? We have taken the benefit in the past and now we are paying for that. So that is known as what? Expense. Okay, now salaries. Okay, now we have taken the benefit from the employees for a particular month. Okay, we have made them work for a month, and at the end of the month we are paying them the salary. So in past we have taken the benefit, we don't have the future economic benefit from this. Okay, so these are known as what, the expenses. Fine. Now let's see what is income. Okay, income is also known as the revenue. Now revenue is the amount earned by the business by selling the goods. Okay, by selling the goods or rendering the services. Now the major source of any business, okay, the major source of any business will be what? By selling the goods. Okay, they sell goods and in return they receive the money. Okay, they will generate the revenue. So the major sources were selling the goods, but also it includes other incomes such as commission received, interest received, dividend received, etc. Okay, now suppose we have invested the money somewhere. Okay, we have invested the money somewhere, so for that investment we are receiving the interest. Okay, so that interest is what? It is the income to the company. In the same way, commission received, dividend received, this all are what? The incomes to the company. Fine. So this was the meaning of all these types of accounts. Fine. So now we will see the rules behind it. Okay, how to apply the rules. Now the rules of debit and credit in this modern approach are, now we had six types of accounts here. Okay, assets, drawings, expenses, liabilities, income, and capital. So we will divide this six type into two groups. Okay, three each. Now this assets, drawings, and expenses have a debit balance. Okay, they have a debit balance, and this liabilities, income, and capital have a credit balance. Fine. Now see, this assets, drawings, expenses, they have a debit balance. So to increase it, we will debit the account. Now when it decreases, we will credit the account. Fine. So it is opposite in the second group. Now here liabilities, income, and capital have a credit balance. So to increase them, what we will do? We will credit it, and to decrease them, we will debit it. Okay. So you may be saying that what is this increase and decrease? Okay, so see, I'll give you a simple example. Okay, now see, suppose if you have purchased the asset, if you have purchased the asset, so your assets are increasing. So when your assets are increasing, what you will do? You will debit the asset account. Yes. So if you suppose if you sell the assets, okay, if you sell the assets, your assets are decreasing. Your assets are going out of the company. So when the assets are decreasing, you will credit the asset account. Fine. Now let's see the example of liabilities. Okay. Now see, if you took loan from a bank, so your liability is increasing here. So immediately to increase your liability, you are going to credit that. Okay. To increase your liability, you are going to credit that. As simple as that. Okay. So let's see another example of the expenses here. Okay. Now suppose now you have to pay an electricity bill. So what is an electricity bill? It is an expense to the company. So your expenses are increasing here because you are paying the electricity bill. So your expenses are increasing. So for increase, what you will do? You will debit the electricity account. Fine. Now suppose rent paid. Rent paid is an expense here. So if your expenses are increasing, again you will debit it. So if it decreases, you will credit it. So same thing for all this types of accounts. Fine. Now, so see, to remember, there is one trick here. Okay, the second group contains liabilities, income, and capital. Okay, so this is what LIC. So it's a simple trick to just remember this, that LIC, liabilities, income, and capital, this come in one group, and the another group contains what? Assets, drawings, and expenses. Fine. So these were the rules of debit and credit. Okay, so this thing I have written in a table format. Okay, here we have the types of account: balance, increase, and decrease. Okay, so see, first this assets, drawings, and expenses are in one group. Liabilities, income, and capital are in another group. Now this assets, drawings, and expenses have a debit balance, and to increase them, what we will do? We will debit the account, and to decrease them, we will credit the account. And the second group, liability, income, and capital, have a credit balance. To increase them, we will credit the account. To decrease them, we will debit the account. Fine. It's very simple. The only one thing here you should remember that now you should be able to categorize the accounts. Okay, you should understand that which are the assets, okay, which are the expenses, which are the liabilities. Once you are able to understand what are these types of accounts, then you can easily apply the rules. Fine. So that's it for today's class. Hope you liked this video. Don't forget to like, share, and subscribe to my channel. Thank you.